Welcome to Uncovering Trusts, a podcast by the Edison Group, a content-led IR business integrating analyst content, digital targeting, and investor engagement. Each episode will uncover the distinct features and latest developments of a selected listed investment company. So tune in to find out interesting investment ideas and stay on top of what's happening in the investment companies sector. I'm your host, Will Manuel, and today I'm joined by Milosz Papst, Director of Investment Company Content at the Edison Group, who will talk about the Diverse Income Trust. Ticker is DIVI. So Milosz, thanks for joining us today.
Hi, Will. Thanks. Good to be here.
Right, so let's jump in. Shall we start with a high-level introduction, which may be particularly helpful for those listeners who are less familiar with the Diverse Income Trust, which we'll refer to as DIVI.
Okay. Well, the important feature to bear in mind is that DIVI offers investors a unique proposition. The trust's co-managers, Gervais, Williams, and Martin Turner at Premier Miton, employ a genuine all-cap UK equity income strategy. They focus on generating a dividend income stream that is more resilient and has the potential to grow faster than those of DIVI's peers. The managers believe that over time, this strategy should lead to superior capital appreciation as well as income growth, and that an income focus offers the prospect of good returns regardless of equity market conditions. Gervais and Martin consider that during periods of economic uncertainty, there is risk in focusing on capital appreciation, particularly on businesses that are dependent on raising additional capital. No gearing has been employed since the trust was launched in 2011. Recently, Divi's board negotiated a lower-tiered annual investment management fee of 0.9 to 0.7%, down to 0.8 to 0.7% with different tiers, which became effective on the 1st of June 2024. There is an annual redemption facility available, and in May 2024, during a period of low investor appetite for UK small cap stocks, around 26% of the share base was tendered.
Okay, thanks. So you mentioned that UK small cap stocks are out of favour. So can you provide some perspective on the investment backdrop and perhaps touch on valuations?
Yep, of course. UK stocks in general have become less appealing to global investors, who now make up around 2/3 of the UK shareholder base. Since the 2007-2008 global financial crisis, the UK weighting in the MSCI World Index has declined from 11% to less than 4%. This may be due to the UK being viewed as a lower growth market. As an example, the UK has a minimal exposure to technology stocks, which compares to the dominant US market, where IT is the largest sector at more than 25%. As a result, the UK market is looking very attractively valued in both absolute and relative terms, as it now trades at a forward PE ratio of around 11 times compared to close to 17 times for global equities. The UK market now offers a dividend yield of roughly 3.4% compared to 2.1% for global equities. So an improvement in investor sentiment towards the UK, perhaps due to sustained evidence of a more robust domestic economy, or if large cap US technology stocks lose their luster, there's potential for a meaningful upward re-rating of the UK market. Now, drilling down in more detail, why there has been a greater appetite for larger rather than small cap UK companies in recent years, over the long term, small cap businesses have generated superior total returns for shareholders. DIVI's managers explain that this is known as the small cap effect, where the returns of quoted companies are broadly inversely related to their market caps.
Okay, very interesting. Thank you. So, given the wide all-cap mandate of the trust, can you explain a little bit more about the stock selection process?
The managers select stocks following thorough fundamental research, seeking companies that can generate sustainable cash flows to support growing dividend payments. There is a bias towards smaller firms, which are often under-researched and therefore may be undervalued. Gervais and Martin use a traffic light system, red, amber, and green, to assess companies based on 5 key questions. 1, are there prospects for rising turnover? 2, can corporate margins be sustained? 3, is the management team good enough? 4, how much financial headroom is there in the balance sheet? And finally, 5, does the share price reflect low expectations? The managers are unconstrained by index considerations and have a very wide universe from which to source attractive opportunities. These companies include mature businesses with surplus cash available to fund sustainable growing dividends, AIM-listed companies that are dominant in their respective fields, enabling them to generate surplus cash and superior dividend growth, and businesses where a long investment phase comes to an end, paving the way for substantial future cash flow and dividends. Gervais and Martin also rotate out of companies that have appreciated significantly, resulting in a lower dividend yield, and reinvesting the proceeds into companies that are attractively valued and have dividend growth potential.
Right. So thanks for covering their process in some detail. So now would be a good time to find a bit more out about Divi's portfolio. So can you tell us about their sector exposure, the market cap exposure, and sort of risk profile of the trust?
Yeah, so as its name suggests, the trust is indeed diversified, as its portfolio has one of the longest list of holdings, around 120 names, in the 18-strong AIC UK equity income sector. DIVI has exposure to all 11 market sectors, the largest being financial stocks, which make up more than a third of the portfolio. In terms of market cap, generally the broad split is 25% large, 15% mid, and 60% small cap shares and cash, which tends to be in the single-digit range. DIVI's less diversified peers are reliant on fewer companies to generate their income, which is a riskier approach, while the trust's multi-cap strategy provides a broader investable universe, which also reduces DIVI's income risk. The trust's lower risk exposure to the UK equity market is illustrated by the cumulative upside-downside analysis, with measures well below 100% in both rising and falling markets. While DIVI may not fully participate when share prices rally, there should be an element of downside protection during periods of stock market weakness. However, a low beta portfolio does not mean a lack of alpha. Data from the company highlights that since launch, DIVI has outpaced the performance of the Deutsche Numis smaller company plus AIM, excluding investment companies, and all share indices. Around 60% of the trust's historical returns are from compound income versus around 40% from capital gains.
Okay, great. So as income is the focus of this trust, can you provide some more information about Divi's dividend?
The trust's annual dividend has increased each year since the fund was launched, compounding at an average annual rate of around 6%. Now, in normal market conditions, DIVI has a fully covered dividend. The only exception to this was during COVID, when the FY20 annual payment was 0.9 times covered, and there was a small drawdown from reserves in FY21. The trust offers an attractive above-market yield of around 4.45%.
Okay, great. So that just about wraps things up. Thank you for an interesting rundown on this unique income-focused investment trust. You've been listening to Uncovering Trusts, a podcast by the Edison Group. If you want to find out more about Divi and other investment companies we cover, please visit www.edisongroup.com. Thanks.